Sophie, what do you make, first off, of the big slide in tech stocks? I was noticing that Apple lost over $170 billion, almost half of Tesla's total market value.
We heard so much about this tech bubble of the summer that, it's finally happening. In my view, I think you have this reality check several times a year, and back from the summer, back from vacation, when you look at your portfolio and risk, I don't think it's absurd to think that some investors would find the equity market a bit frothy and they would just take some profit. But I think very important to keep in mind is that institutional investors' positioning did not show any signs of exuberance, which could indicate that the sell-off could be rather limited.
So you don't think this sell-off has legs then? I mean, you don't think this marks, rather than just some jitters at the beginning of September, an actual turning point in the rally?
I don't think so, because we're still in this Goldilocks scenario: low interest rates, easy policy mix. The fact that when you look at the equity risk premium is still 1% higher versus pre-COVID-19, and the rotation into cyclicals hasn't happened yet. So all this taken into account, I think it's more like some profit-taking short-term rather than the start of a downtrend, because all the conditions are met for another leg of melt-up.
In terms of valuations, the S&P 500 is still valued at 26 and change times the forward earnings estimates. Do you think earnings estimates as well are going to continue to come down?
If you look at earnings estimates on a forward basis, if you look at 2020 and 2021 EPS growth, for the whole S&P, a V-shape of earnings is already priced to perfection. In terms of what could push valuation higher, as I mentioned, tightening of the equity risk premium, which usually happen at the early stage of the economic cycle, could push multiple expansion, and this hasn't happened yet, so I'm really counting on this. But in terms of valuation, you're right, it could look a bit stretched, but if you take the FANGs or the tech companies out, the S&P is not that expensive.
Yeah, I've heard talk from at least some big bulls, Sophie, that PE valuations really aren't the way to look at stocks right now. Do you agree that we need to be looking at them with a different paradigm, through a different paradigm?
Totally. I mean, I think something we are really underestimating, and I think that's why real yield went so low, is how do you invest in portfolios when you have 14 trillion of negative yielding debt in the system? So I don't think it's absurd that some investors are drawn into other asset class where they think it could look more like bond proxy, and the equity complex with the growth and quality components benefited a lot from it. And who has a lot of growth and quality? That's basically US. And that's why, apart from the diversification out of US dollar that we have seen over the summer, the diversification out of US equities hasn't happened yet.